gold goes lower, and I even think silver is probably headed to $50 an ounce or lower. I still think there's another $600 downside in gold before it becomes a major buyable level. Just to show you, that would be the low end of this parallel. So we could be due for a 1 or 2 day bounce here on gold, but I still think gold is going lower, and my price target still remains by year end or early 2027 at 3,500, give or take. But institutions have to play catch up with the AI trade, and so a lot of money has been arguably taken out of gold. And I think we even saw this with central banks. Is central banks for a couple months, I think they stopped buying as much gold. With gold, it's only as good as the last few months of price action. And right now, most people jumped into this and FOMO'd in at higher levels, so they are now down net on their gold positions. We saw with the 10 years it started to move almost identically with oil. And the reason is, obviously, oil going up was inflationary, and therefore rates have to adjust up to counteract that inflationary pressure. I'm still in the camp that as much CapEx is being spent in the AI trade, 90% of the remaining economy is struggling like crazy.
Gareth, let's turn now to precious metals. We talked about stocks and Bitcoin. Gold has been range bound, and in fact does. It's interesting how gold versus 1 year ago is still high, versus 2 years ago is extraordinarily high, versus 3 years ago in 2023, it's up 138% from current levels, and yet the sentiment is very weak just because it's down from $5,400 an ounce.
Right.
But I'll let you comment on this technical pattern that you have on the screen right now.
Yeah, so this hasn't been amazing. It's been why I've been bearish on gold, is that ultimately, notice we have a low, lower low, high, lower high. It makes a perfect parallel. And what this tells us is that we're probably going even lower in gold. And one of my main thesis for the fundamental side is that people bought into gold when it was running up in the November, December into January period when we were making the all-time high. They thought it was get rich quick, right? And gold is not that. If you've been in gold for more than a couple years, you know that it's basically a hedge against inflation, against debt. It's basically the safety trade. It wasn't behaving like that late last year, early this year. And so it has to flush out those players that bought in for the wrong reasons. They're getting bored with it. That's going to drive price lower. We are coming into a little bit of support. This pivot low here from March 23rd is at 4,100. We basically kissed it today. So we could be due for a 1 or 2 day bounce here on gold. But I still think gold is going lower, and my price target still remains by year end or early 2027 at 3,500, give or take. So again,
markets celebrated a 138% move in gold, then suddenly decided protection was no longer worth owning. As Gareth Soloway points out here, price structure is weakening even while the long-term monetary backdrop remains unresolved. That contradiction matters more than the chart itself, because speculative money treated gold like momentum tech instead of financial insurance. If weaker hands continue exiting, the damage won't hit Wall Street first. It hits savers who assumed owning gold meant immunity from volatility. Next, Gareth Soloway exposes why institutional patience in precious metals rarely aligns with retail expectations.
I still think there's another $600 downside in gold before it becomes a major buyable level. Just to show you, that would be the low end of this parallel. So it would mean we would revisit this low end of the parallel. And then look at this trend line here. This beautiful trend line comes up right into that if we just connect these lows. And remember, trend line stands for trend. And so you have essentially gold was just hopping along this trend all along here before it took off. It kind of makes sense that we need to come back and revisit that trend to find major support. And you're still in a long-term uptrend. I want to be clear on this. There's nothing bearish long-term about what's going on. This is just flushing out the irrational exuberance that we probably will see in the AI stocks and a lot of these other ones. That's just happening in gold. So again, I would remain looking for further downside with bounces on gold.
The institutional interest that held up gold, is that narrative still here?
I think it's weakened. I think it's weakened somewhat. I think it will resume, but institutions have to play catch up with the AI trade. And so a lot of money has been arguably taken out of gold. And I think we even saw this with central banks. Is central banks for a couple months, I think they stopped buying as much gold. I think part of that also was protecting against the potential risks of oil popping, the Strait of Hormuz being closed, the military action. Was this going to spread wider? And so I think they were out trying to save money and allocate it potentially to different spots. But ultimately, I think, again, gold goes lower, and I even think silver is probably headed to $50 an ounce or lower.
Yeah. This is our mutual friend Ben Cowan. No hate on Ben.
Central banks slowed their buying, just as public narratives kept calling gold the safest place to hide. According to Gareth Soloway, a return toward deeper support would not invalidate the secular uptrend. It would expose how crowded the trade became. Institutions rarely abandon a thesis. They reallocate when a hotter narrative appears. And AI has absorbed capital that previously flowed into metals. For wealth preservation investors, timing mistakes inside the right asset can still become expensive. Next, Gareth Soloway reveals what institutional capital rotation says about the next phase for silver.
We love Ben. I just saw this tweet from October, and I'm bringing this up because this is great. When it first reached $4,100, there were flame emojis. And that was a sentiment. It's about to climb much higher. We're at that level now on the downside, and we're talking about further downside. This just to show that technical analysis does not care about the level so much as about the momentum and the direction.
That's right.
So the level in isolation doesn't mean much. So what do you think of the fact that just less than a year ago, people were really excited at $4,100, and it wasn't just Ben. I'm not singling him out, but people were really excited about $4,100, and now people seem the mood is despondent at $4,100.
Right. It's what I say in everything I do. I'm only as good as my last trade. So if I have a great trade, I'm great. If I had my last trade, even if I won 100 times before in the trade, you're only as good as your last trade. With gold, it's only as good as the last few months of price action. And right now, most people jumped into this and FOMO'd in at higher levels, so they are now down net on their gold positions, and that means that they're going to be very despondent, right? They're going to be not happy about the price action. Again, I think it's important for everyone watching to remember that if you're in gold, you're not in it for the quick buck. It's great when it does the quick buck, but you're in it to basically an insurance policy against what the government is spending and racking up in debt and inflation and other factors. That's a long-term narrative.
The exact same price level triggered euphoria on the way up and despair on the way down, and that should concern investors more than the chart. What Gareth Soloway is highlighting is that sentiment follows recent pain, not valuation or purpose. Gold became a momentum vehicle for late entrants when its historical role was wealth defense against debt expansion and currency dilution. Investors who confuse insurance with speculation usually abandon protection right before they need it most. Next, Gareth Soloway unravels why investor psychology and institutional positioning rarely move together.
Not a short-term, like, where is it for the last couple months?
By the way, the 10-year yield has been rising dramatically, and people are concerned about what this means for not just the bond market, but the entire economy, as everything is based off the 10-year yield. HSBC called 4.5% the danger zone. And I wonder from your perspective whether or not this is going to get much higher still.
Yeah, and this is really quite something, because what we saw with the 10 years, it started to move almost identically with oil. And the reason is, obviously, oil going up was inflationary, and therefore rates have to adjust up to kind of counteract that inflationary pressure. I think, and I'm still in the camp, that as much CapEx is being spent in the AI trade, I actually think that the overall 90% of the remaining economy is struggling like crazy, just like Americans are and many people around the world. And I do think that eventually the economy is going to slow down, and that will bring in rates. Now, listen, down the line, if you ask me 5 years out, if the U.S. debt continues to add $3-4 trillion a year, there's going to be bigger issues out there. But I do think that shorter term, the economy or the stock market coming in could bring yields back in a little bit, and that's kind of what I'm anticipating.
What are you expecting Kevin Warsh to do or announce next week? Let's end it here. And this ties into our yield discussion and, more importantly, where the Fed funds rate is going to go.
Yeah, so I would expect Kevin Warsh to not scare the market about raising rates. I think he's going to stay very measured. He's got to walk a tightrope.
This exact yield setup appeared before prior growth slowdowns, but headlines are treating it like proof the economy is unstoppable. Gareth Soloway's argument suggests rising long-term yields may be doing tightening work before the Fed officially acts. When oil and yields move together, inflation fear can distort what markets think growth actually is. For ordinary investors, higher yields quietly reprice mortgages, valuations, and retirement assumptions long before recession headlines appear. Next, Gareth Soloway exposes the contradiction between rate expectations and what bond markets already priced in.
Between the hawks on the Federal Reserve and the President Trump, who wants obviously rates to come down, and kind of every time we get a good jobs number and the markets sell off, he kind of says, what the heck, why is that happening? But in reality, I expect a very measured, this is going to be how Kevin Warsh is remembered going forward. His first press conference, he's going to be very measured, very calming, and he's probably going to walk the line of saying, hey, listen, we're not going to cut rates, but we're here if the economy weakens to cut rates, and we're also going to make sure we monitor inflation. So I think it's going to be a very right down the middle description, but I don't expect a rate hike or cut.
CME FedWatch tool is expecting by September a 33% chance of a 25 basis point hike and a 3% chance of a 50 basis point hike. By December, the odds of some hike, whether it be 25 or 50 basis points, climbs to 42 plus 20, 60, more than 60%. Yikes. Yep. So I don't know how much scaring he can do. The market's already anticipating this later in the year.
And that actually could set up, if he's a little bit more measured and we see these numbers come down, I think the market could actually rally off that.
Interesting. Last Friday's jobs numbers beat expectations out of the water. Do you think that was a contributing factor to these probabilities being raised on the hike?
I do. And again, remember, inflation is partially a shock based on oil. It's also a partial factor of the more people that have jobs, the more money they're making. And you could argue with
good economic data now creates fear instead of confidence. And that inversion should make investors uncomfortable. This is where Gareth Soloway's thesis shifts from market prediction to policy psychology. Strong jobs numbers are no longer universally bullish because investors assume growth can delay relief and extend tighter conditions. Savers focused only on headlines risk missing how expectations, not decisions, move asset prices months in advance. Next, Gareth Soloway reveals why markets may already be reacting to a rate move that never happens.
Whether or not you believe the jobs numbers, but the market does, and that's what matters, is that the more people that have jobs and make money, the more competition for goods and inflationary that can be. And so that's an issue. That's why in recessions, usually rates can come down, is because you have deflation or disinflation, versus in expansions, that's usually when we see inflation come in.
And I'll just end on this note. I am just concerned about, I'm having PTSD flashbacks to 2022, the last Fed hike cycle. And people saw this coming from miles away because inflation was very high in 2021, as you recall. But still, the markets didn't price in for what happened next, which is a Fed rate hike cycle. Markets went down. The S&P went down 28% in 2022, which is brutal for the whole year. I wonder if that setup is what we're seeing now, or perhaps this time markets will go a little bit easier on a Fed hike.
Yeah, I think especially if it's a one and done type scenario, then I think the markets would go easier on it. The other thing I would just throw in there is that the 10-year yield has already put rates up, right? We've seen rates climb above 4.5%. So even if the Fed funds rate gets raised by 25 basis points, I would argue that does that even have much of an impact if the 10-year yield is already up 25 basis points and has been up for 25 basis points for the last couple months, right? It's almost like the market did the rate hike for the Fed already.
The market may already be living through tightening while waiting for the Fed to announce it officially. As Gareth Soloway points out here, long-duration yields have quietly done part of the central bank's job before policy changes arrive. Investors focusing only on headline rate decisions can miss the deeper signal hiding in financing conditions. That blind spot becomes costly when portfolios are positioned for easing, while markets are behaving as if tightening already happened. Next, Gareth Soloway exposes why the bond market sometimes front-runs the central bank itself.
I want to address this question on my screen. How high will the S&P get by month end, which is a trade right now on prediction markets, by the way. Instead of trading directly with the S&P, you can trade on prediction markets. Brave new world we're living in. But what do you think of the pattern day trading rule that's been eliminated last couple of weeks ago? The $25,000 the $25,000 limit or requirement that you have to have in your trading account before you're able to trade up to 5 times a day, or more than 5 times a day.
5 times in a week, in fact, or I think you were allowed 3 or 5 day trades in a week. So it was really, that was the prior thing. So it's been a big change here. I would say this. Number one, I like it. I like the fact it's changed because I don't like when restrictions are put on smaller, like why should someone else be penalized, than someone who's wealthy, right? It's even the playing field. Having said that, investors should know that day trading obviously is very high risk. 95% of people that try day trading lose their money. So people have to be also very aware of the stats as well. But again, I'm all for people, owners, own your own decisions, own your own results. I've got to own my own results in my own trading. Everyone else can. So if you want to day trade, have at it.
I wonder if this actually makes any significant impact, because you're right. The larger traders and institutional traders who trade multiple times a day, they have account sizes that will allow them to scale multiple trades a day.
Removing barriers for small traders sounds empowering until you ask who benefits from more retail participation. According to Gareth Soloway, access and probability are not the same thing, and that distinction matters. Institutions already had scale, speed, and liquidity advantages long before rules changed. For individual investors, protecting wealth, activity should never be confused with edge, because turnover often transfers capital upward. Next, Gareth Soloway reveals why democratized trading can still produce institutional outcomes.
If you have less than $25,000 in your account and you're trading 10 times a day, you might get your profits eaten away by brokerage fees.
That's possible. The other thing to point out is that these smaller accounts, oftentimes they can be in a position where they are already trading 0-day options, which is arguably even more risky than day trading. And I don't believe there's a restriction on 0-day options at all anyways. So I agree with you. I don't think it's that big of a deal. I mean, it's nice if someone has a smaller account than 25K to be able to day trade. But overall, there have been so many ways with perpetuals now, right? I mean, there's so many ways to get around this rule that's probably why they did away with it.
Okay, so traders are assigning, on Kalshi rather, this is from Kalshi Prediction Market in the U.S., assigning a 24% chance S&P will get to above 7,630 points by the end of the month, and 7,640 points, 31% by the end of the month. I'll flip over to your screen now and let you answer that. How would you evaluate the odds of it going to much higher? Well, not much higher, but flat and slightly higher.
Yeah, I would, based on what I've seen in the last couple days, I would say that's a very low probability scenario. The reason I say that is that ultimately we have now broken a key upsloping trend line from the lows of March. So you can see again, it kind of started here. We went away from it. Then we came back in and we were just kind of hopping along this trend line until it broke. In addition, if you look at the volume and the size of
markets keep selling the idea that more access equals more opportunity, while ignoring the math underneath participation. What Gareth Soloway is highlighting is that speculative behavior has already migrated into products with fewer guardrails than traditional day trading. Prediction markets and ultra-short duration trades create the feeling of control while compressing decision quality. For long-term investors, velocity often disguises risk instead of reducing it. Next, Gareth Soloway unravels why market structure may matter more than market direction.
These red sell days, the Friday sell, and even yesterday before the bounce back, there's massive volume that does huge technical damage to the charts. And lastly, you actually made your first lower low on the charts since the rally began. So you can see this is a lower low. Yesterday's low pivot was obviously lower than where we were. And so these are beginning signals that you may be entering a downtrend period. Now, again, I don't think the markets fall significantly ahead of SpaceX because I think the institutions need to keep it up. But I would just caution, if you look at midterms, there's usually a sell-off in the summer before the midterms. There's other factors also, inclusive of the overbought semis, that probably bring this market back in a little bit.
What are the major fundamental risks facing the market right now with AI CapEx on an uptrend? And, just one example, SpaceX just announced that Google might be paying them more than $900 million a month for AI data center compute sharing. So the circular finance is still going on. People are still looking at AI CapEx driving up the and good earnings driving up the S&P 500. What could slow that down, though?
So the biggest thing here is that expectations are insanely high, right? So when we look at this, we assume CapEx will go up 200 billion every year. So next year it's going to be $1 trillion, then 1.2, then 1.5, et cetera. And at some point, one of these companies that's talked about, Google spending 200 to 300 billion a year, whatever they're spending, at some point they're going to say, you know what, next year we're going to spend the same amount as last year, not more. And that will be like a basic collapse in the system.
Markets rarely break because growth stops. They break because growth stops accelerating. Gareth Soloway's argument suggests investors may be underestimating how dependent valuations have become on continuously rising AI spending assumptions. Once expectations require exponential expansion, even stability can feel like disappointment. For retirement portfolios and wealth preservation accounts, narrative risk becomes just as dangerous as economic risk. Next, Gareth Soloway reveals the hidden threshold where enthusiasm turns into valuation compression.
Meaning that people have priced in such incredible growth in CapEx and in earnings and so forth. Any sort of change in that could be detrimental. And I would just draw your attention to Broadcom. Broadcom, they basically came in line with estimates, but they didn't raise guidance. The stock has collapsed just because they didn't raise guidance. They kept guidance the same, down 25%. And so what this tells us is that if there's any sort of problem in the growth aspect of this trade, these stocks are going to get crushed, and we know the market trades with these stocks. They will all get crushed as well.
The most dangerous market phase begins when meeting expectations becomes indistinguishable from failure. This is where Gareth Soloway's thesis shifts into a warning about expectation inflation rather than price inflation. When companies deliver strong numbers and still get punished, the market is signaling saturation in belief, not weakness in fundamentals. Investors concentrated in momentum narratives can lose years of gains before headlines admit conditions changed.